Mr. UR Bhat, Managing Director at Dalton Capital Advisors, with us on the show. Mr. Bhat, good having you. Thanks so much for joining in. Will it be a calm before the storm, or would you expect that it'll be yet another day of trade and business and nothing too much untoward? I'm referring to the obvious.
No, I think there would be peace. I think there's no point in having a showdown. I think better sense will prevail on both sides, and I think there'll be some sort of a middle ground found.
The markets have kind of given that indication that what they believe, right? And not just the equity markets. We are approaching that meet with a fair bit of uptick on the equity markets, 3 straight weeks of gains. The currency at 71.9293 has also not approached this with any kind of flutter.
Not really. I think there's a lot of background work that has gone on before this meeting. So therefore, I think they would certainly be. I mean, I don't think they'll play to the gallery. They would have some serious, mature talk, and they will sort of compromise.
So what does that do to markets then per se? Because we passed some major cues. The next big cue is probably the G20 or the state elections, and both of them from a world market perspective and India market perspective important. How do you think the next 20 days stay, because they are fairly crucial?
Well, I think the G20 would be very critical because based on what has happened in APEC, I think the tariff war seems to be extending. So therefore, that is something that we need to keep a close watch on. Plus, of course, there are other, Middle East is in the boil. You have Brexit fears. I mean, all unfounded fears really playing out very starkly. And the US continues to do well, so therefore I think it's attracting quite a lot of money there. So therefore emerging markets are not exactly going to be the great favorites in the next 20 days, as you said. But domestically things seem to be all right, except for especially the results have been reasonably all right. So therefore I think till now we were always saying that the results will start picking up, and the market ran up because of that. Now the earnings growth is coming, and the market is somewhat skeptical. So it's somewhat ironical. But the fact is that there are enough uncertainties on both the domestic and the international side. So therefore, I don't see the market running up dramatically from here.
What about the recent FPI numbers? I mean, for the month of November, the first half, nonetheless, has been encouraging. We've got already $1 billion worth of investments that have come in. Is that laying ground for what could happen in the near term, where more money could come in?
Well, I think yes. I mean, because that was the time. That was the time when things were reasonably secure. But right now we have these uncertainties coming. But given the sort of outflows that we had for the last several weeks, I think this was a small-time correction, as it were. But I think the level of uncertainties are not going down anytime soon. So therefore, I think market would probably find it difficult to take it up from here dramatically.
Right, but the domestic money is still there. It's going strong on a month-on-month basis. So does that provide a little bit of a kicker?
Indeed, I mean, that's the only one that has been supporting the market for so long when the FIIs were selling. But I think it can support probably $1 billion to $1.5 billion per month, but not more than that. When you saw that FIIs were selling a bit more than that, the market's really corrected. So therefore, I think to the extent of about $1 billion per month, I think the FIIs, the domestic savings can support. But much more than that, if it is there, I think markets can correct.
Why do you say that for you're saying that the earnings were okay this time around?
Earnings, I think, for the first signs of pickup we saw. Because still now we've always been trying wolf, saying that earnings are just around the corner. But I think for the last probably 7-8 quarters we were saying that, but nothing happened. But this is the first time when we are really seeing some pickup in earnings, at least in some sectors, and so therefore there is reason for cheering. And the market also has corrected probably something like about 9-10% from the peak, even at these levels. So therefore, I think from the fundamental side, things seem to be all right, except on the export side, on the oil side, I think there is still uncertainty. But otherwise, I think there's a reason for the market to be sort of stable around these levels.
Right, but just to highlight for us, where were you encouraged in terms of seeing earnings? Because there are still a lot of downgrades that have come in post earnings in terms of the EPS downgrades.
Well, if you see the industrial side, and if you see some of the banks, the better banks have done well, then only there has been some problem with NBFCs. But other than that, even the auto numbers have, of course, probably been slightly slowing down. But nevertheless, I think that is one sweet spot that we have seen, because even the economy was not doing well, that is one sector which continued to progress. So therefore, I think in these areas there have been some, for example, even in commodities, things have been very good. If you see steel results, they have been quite encouraging. So it's the first time you are seeing double-digit earnings growth in at least some of the sectors.
Okay, what was the most impressive earnings highlight for you? I mean, small companies like paper sectors have done really well. Specialty chemicals did very well. Capital goods, Siemens today has done very well. What does that stand out for you?
Well, I can't talk stocks, but
engineering
and industrials, I think, for the first time has started showing some uptick there. So I think that is sign of an economy which is really, doing reasonably well from the lull that we saw for quite some time.
Interesting. Good enough for you to go out and contemplate making fresh investments there, or is it still in the realms of observing these companies and then taking a call once more print comes in?
I think you have to put the foot in the door because there's some uncertainty over the next, say, about a month or two, and so at that time there might be further correction, so you can probably increase your stake. But otherwise, I think this is the time you have to start nibbling.
Would you say the same for corporate-facing banks? Because while there were earnings downgrades on the back of the fact that provisioning numbers increased, there was the silver lining of the fact that new slippages didn't increase that much more. So you see us making a top in terms of the NPL cycle?
I think so. NPA cycle, the worst of the NPA cycle is behind us, I think now. Even public sector banks' results, if you see, quite a lot of them have, they continue to make losses, but I think the losses are not increasing, at least dramatically. So I think there is some hope in that at that end. And of course, for public sector banks, the recapitalization is a big issue. But as you said, the corporate-facing banks, private sector banks, I think there's a lot of hope there.
Now, I have a follow-up actually on banks, Mr. Bhat. A few people, large investors, have now started talking about increasing their bets on the mid-size and small-size private sector banks. So everything from a federal to a DCB, at times even Karnataka Bank comes back into the stocks of making a fresh investment in as well. How have you looked at that pocket, and do you believe there is a case for a fresh investment there?
Well, I think even these the mid-sized private sector banks, the old private sector banks, as it were.
Yeah, the old private sector
banks. I think there's a huge opportunity there because almost 50% of the banking system is not able to lend. So therefore, there is a huge opportunity there. Some of them are capital stout, but if they can raise capital, I think there's an opportunity there for them to really capture the growth momentum that is there in the economy, and I think they can give a reasonably good account of themselves.
But it's a story, Mr. Bhat, that has always come in the past that this time around they have the opportunity. But they've somehow, even if the banks may have done reasonably okay, they've been pulled back by a number of issues and they haven't quite created wealth in a serious way for investors. Can this time around be different?
Could be. I think this sort of opportunity, this size of opportunity has probably not presented itself. But I think capital is a big issue there. So they should be able to raise capital. And if they're able to raise capital, I think they can capture this opportunity and make it look like this time it is different.
For most of the public sector banks, there's still a lot of capital requirement.
Correct.
Do you see that being a key challenge for them?
That is a huge challenge for the last couple of years now. But I think the government has to do something about it.
Not just growth capital, but capital to meet your regulatory requirements.
Well, I think quite a lot of them are just below that. That is why you have 11 banks under PCA. So therefore, I think this matter has to be addressed. I think it's very serious. You cannot have India growing at 7-8% without 50% of the banking system participating in it. So therefore, it is a very serious matter. Some, I think, solution has to be found. I think government will probably do this sooner than later.
One pocket, that probably from Q1 to Q2 saw a fairly divergent move was the cement pocket. First quarter realizations were better off and volumes also picked up and it looked like a pocket of interest. Come Q2, it seemed to have probably reversed its way backwards. What's your sense?
Well, I think this is one sector which would probably have a secular growth, but I think there are huge capacities being created which is actually not giving them enough pricing power. But they will probably, the steady growth is reasonably assured, but I think pricing power sort of returns and goes off depending on commissioning of new capacities. And of course, I think valuations are a bit stretched there. But I think this is a sector which is an important sector to keep watching, but I think when the market probably corrects, you can probably...
But also a function of the kind of infrastructure activity that we're expecting to take
that has been quite robust. Infrastructure activity has been quite robust. That's why you continue to see growth, but it's just pricing power that's a problem there.
Interesting. In today's session, by the way, Yes Bank is now up 5%. And my last question is related to the next 2 or 3 stocks. Eicher Motors, 2.5% higher, so 25,000 from those lows of 21.5 back to 25,000. Maruti from those lows of 6,500 back to about 7,300, 7,400. a pocket that almost everybody believes written off, the growth numbers won't come in, and the results didn't do justice either. Yeah. But the market buoyancy has led these back. What does one do with some of these premium valuation auto names, be it a four-wheeler company like Maruti, or be it a niche two-wheeler like Royal Enfield or Eicher Motors?
Well, I think quite a few of them have disappointed in terms of the last quarter numbers, but I think it doesn't say anything about the secular growth story that is still in place. Valuation is always a point of discussion. So therefore, I think some of them are really, I mean, you said premium, they're super premium, some of them. But I think at the right juncture, when there is some correction in the market and you have opportunity, you should be holding on to these stocks because these are secular growth stories.
What else do you like? Anything that flavor for you?
Well, I think it is just private sector banks continue to do well. Then you have pockets of auto and industrials. I mean, these are the sectors that you need to be in.
All right, we'll leave it at that, Mr. Bhat. Thank you so much for joining us.
Pleasure.
Appreciate it.
Thanks, Mr. Bhat.
Pleasure. Thank you.